Good evening, everyone. I hope you're all fine. I'm doing this video as a popular request, right? So I'm coming to provide my suggested solutions for last year's investment fundamental past questions. So 2023, 2024 investment fundamentals. So let's roll. Please note that the video will be long. So you can put it at 2x, right? Because look at something here. It's not that I'm talking alone. The paper is a 3-hour paper. And with that one, you only answer all of question one, and then the rest, you choose some. With that one, is 3 hours. But I'm coming to solve all this here. So if I take 3 hours in poor, please don't talk. I beg you. All right. So uh, let's begin. All right. So kindly like this video if you find it helpful, and also subscribe to the channel for more updates and info. So now, this question one. This question one looks exactly like the tutorial set 5 that I just solved just some few minutes ago, a few hours ago. Right. So your firm, I don't have a firm. Alpha Securities has invested 40% of its funds in asset X and the remaining 60% in asset Y. So with this one, because I've solved it in the tutorial set, I'm not really going to explain plenty again. I'm just going to solve straight. So the remaining 60% is assets Y. The price of assets X and Y are given in the table below. So these are the prices. So you have to change them to, I'm still even explaining. So you have to change them to returns. So changing them to returns, I think I saw a similar one here. Let me just copy the same thing and then just change the price and then, yeah. All right. So now, all right. So now let's just put in the return of X and return of Y. And so it's in price of X and price of Y. Sorry for the quick commercial break. And just say, see, the before people are just fighting anyhow. For me, come out once and I'm going to pay about back. Then possibly. All right. So let me just insert in the price of X and then the price of Y. So it starts from 2018. So let me just start 2018, 2019, 2020, 2021, 2022, and then 2023. All right, and the price of X is 240. Okay, the first one is 200. 200, 240, 216, 380, 320, 560. Then the price of Y, the price of Y here is 400, 460, 920, 820, 960, then 760. All right. So now, okay. So finding the return on X, which I did it in the tutorial set 5, but let me just go over it here again. Start again. So return on X is going to be the new price over the old price minus 1. If you want it in percentage form, then multiply by 100. But if you want it in decimal form, you leave it like that. So first one here, so first one here is what? 200. For when we are calculating this one, we ignore the first one because there's no return on it. That's why there is 0, 0, 0, 0. Now we come to the second one. We want to get a return 240 over 200. So let me put my calculator. So it is going to be 240 divided by 200 minus 1. So 0.2, that's what we are getting here, right? Then the next one is going to be 216 divided by 240 minus 1. So 216 divided by 240 minus 1. And we are getting this here, 0. The negative 0.1. That's what we are seeing here, right? Then you do the next one, 380, then you do it, and then it follows that and that way. So asset Y is also the same way. You are going to do 460 divided by 400 minus 1. That's the same thing here. 0.15, same thing. Do for the next one, which is going to be 920 divided by 460 minus 1. 1 point. It has changed here. Okay, so 920 or 60. Okay, so it is now 1.80, 1.08. It's 1.09. All right, so that's 1.09 approximately. So the next one, this one was, I think, 820. So with this one, you're also going to get, let me just redo everything because 820 divided by 920 minus 1. We're getting 0.108, so approximately negative 0.11. That's correct. And let's do for the next one, 961. So 960 divided by 820 minus 1. And we are getting 1.70. So yeah, so 1.0, it's the same thing. Then we do it for the next one. 760 divided by 860. Zero point 0.11, so 0.12 approximately negative. It's 960. So approximately negative 0.21, so the same thing here. Now let me cross check all the x1 also. So x, okay, so about 3. That's correct. This one is 320 divided by 380. So approximately negative 1.7. That's correct. And then some 560 divided by 320. Okay, that's also correct. So now, if we want to find the mean, we add all of them. So the sum is just the addition of all the returns. We are not include the first one. We add all the returns, then we divide it by only 5 because we started getting returns from 1, 2, 3, 4, 5. So we divide it by 5, and then we get the um, arithmetic return. So something like this. We add all the returns, so sum all over 10. So the n was 5. So that's the same thing I did here. So you can put it on the calculator where I added all the returns here, and then I divided it by n, which is 5. The same thing is also applied to here, right? But for here, what you are going to do is you take this first one, negative 0.2, you subtract it from this one. You get it? So negative 0.2, sorry, 0.2 minus 0.29. You are going to get this. Then the next one is also going to be negative 1 minus negative 2.9. You are going to get negative 3.9, negative 0.39. So that's how the trend follows. So basically, we are going to use that to find the correlation or the covariance, right? But I'll have simple steps for you to get them without doing these plenty steps. So if you want to get this one also, you're going to focus on y. So you take the return on y, subtract it from the arithmetic mean, and then you get this one. So 0.15 minus 0.2 gets this one. Here to 1.09 minus 0.2 gets this one. This one to negative 0.11 minus 0.2, you get this one. So that's what we are getting here. Right. So let's get the expected return on this one. So the first question was what? Asking us, find the expected return on these two assets. Remember, expected return is the weight of X times the arithmetic return, right? So expected return is going to be equal to expected return on the portfolio is going to be equal to the weight of X times the return of X plus the weight of Y plus the return of Y. So the weight of X in the question is given to us as 0.4 and then 0.6. So X is 0.4, Y is 0.6. So 0.4 times the return on X was what? The arithmetic return is 0.29. 0.29 plus the return of Y, 0.6 times the return on Y is what? 0.2. The arithmetic return is 0.2. So if you do the same thing here, 0.2. Then you are going to get approximately 23.6% or 0.236 any of them. So that is the arithmetic return. Hey, expected return on the portfolio. All right, so the next question is compute the variance and standard deviation. All right, so want to compute the variance and standard deviation. So the variance is you are going to, I won't spend time to do what, so I'm going to show you the steps. So you are going to take one of this and then subtract it from this, and then you square it, right? Either you are going to do it that way, or you have it here already. So you are just going to square all this. So you take 0.09, you square it, plus 0.39, you square it, right? So let's do that. So it is going to be equal to 0.09 squared. So it was negative plus the next one is 0.39 plus, so it is negative, sorry, plus the next one is 0.47 squared. So you are going to add all of them and divide it by n minus 1, which is 5 minus 1, 1, right? And then this way you are going to get a variance. Then the variance is going to give you 0.1988. So then the standard deviation is going to be just putting this in roots, this also in roots, then you are going to get 0.4456. Right, so let me just continue opening. So negative, right? So you add all of them and you do it. Then this is what you are going to get. Right, so now this is for, this is standard deviation of x. So this is for x. Then you do the same process for y. You pick what you've done here already. Negative 0.5, the negatives of squared plus the next one here is 0.89 squared plus, you follow like that, and then you divide it by 5 minus 1, like that. Then you're going to get the variance of 0.2269. And when we find the standard deviation, we are going to get 0.4763. And that's going to be the standard deviation for y. Right, so the next part of the question is saying that compute the variance. Okay, so we've done for x and y here. Now the next one is comment on the standard deviation of x and y. So let's check the standard deviation of x and y. Y is 0.4763, x is 0.4456, which means that portfolio A assets Y is what? More riskier than asset X, because standard deviation of asset X is lower than the standard deviation of asset Y. But that's basically the comment. The next one is that, remember that standard deviation is the measure of risk, right? So that's why we are using it. Now, the V is asking us compute the covariance of x and y. So covariance of x and y is going to be, now what you are going to do is this times this. So you can create another table here, right? Where you say r rx rax times ry rax, any of them like that. You can just do anything like something like that, because that's what we are going to use. So now in this side, what we are going to do is we are going to multiply this by this. Then so that's what we are going to do for. Then we are going to sum them. So this times this also times this. That's what we are getting here. This also times this. That's what we are getting here. Let me leave all into. All right, so that's what we have here. So we can have a sum here. The sum is going to be equal to sum. It means we are adding all of them, right? Which is basically 0.66. This is supposed to be added. So let me keep this in decimal, please. Area still around this. Okay. So after finding this times this times this, all of them, Now, what we are going to do is you just bring it here. So it's negative 0.66 all over. You see, I'm just doing it simple here, but in actual sense, in real life, it's a really tedious work, man. All over n minus 1, 5 minus 1, which is equal to 4. And with this, we are going to get a covariance of 0.66 all over 4. We are going to get a covariance of negative 0.165. Right. Then, after doing that, they said we should find the covariance. So we should find the covariance of x and y. So covariance of x and y is this. And they said we should find what? The correlation of x and y. Correlation will be equal to covariance over covariance of x and y all over the standard deviation of x times the standard deviation y. So we are basically going to pick the standard deviation we computed upwards. So our this thing was negative, the covariance was negative 0.165 all over. The standard deviation of x is 0.4456 and the standard deviation of y is 0.4763 is equal to be around negative 0.7774, right? Or we can leave it at 0. Like this. It's also fine. So this is a correlation, right? But just this thing, for example, I can get you all this with just some simple clicks on the calculator. But I don't think so maybe you'll be getting the full marks in there. But I've taught that in the tutorial set 3, set 5 video. So you can go and watch it and then do it fast from there. So the next question is that we should, what is the implication of the correlation between X and Y in the portfolio construction? So the real deal is that the correlation is negative, right? The correlation is negative. It's negative, which means that the asset moves in the opposite direction. This is better for a portfolio construction because this is going to reduce the risk. So in a portfolio construction, any asset that moves in opposite direction actually reduces the risk in that portfolio. So like what I've said, you have to just try and then put it or reframe it that the correlation being negative is going to reduce the risk of the portfolio, which is therefore going to what? Actually, which is therefore going to make the portfolio less risky, right? Because the assets are negatively correlated. So that's it. And then we move on to the eighth one, compute the portfolio standard deviation. So that's where the plenty formula comes in. Portfolio standard deviation is going to be weight of X times weight of Y squared times A plus, sorry. Hey, then am I in Chakasa with that? Standard deviation of x all squared plus weight of y times standard deviation of y squared plus 2 times weight of x times weight of y times. Now we have covariance, so we just put a covariance. Yes. If they didn't give us covariance, like it would be the standard deviation of x times the standard deviation of y times the correlation coefficient here. Remember, correlation is what? Covariance divided by the standard deviation of x and then y. Right? So if you also want to get the covariance, you are going to multiply the standard deviation of x and y by the correlation. That's the simple one. Okay, so I thought I was done. So let's continue. So the weight of x, as we know in the question, is 0.4 times the standard deviation of x is standard deviation 0.4456 all squared plus weight of y is 0.6 times 0.4763 all squared plus 2 times the weight of x is 0.4 times 0.6 times the covariance that we computed up here, negative 0.165. So minus 0. So after doing all this, we are going to get approximately so basically what we wrote today, that's the same thing I'm typing on it. So we are getting 0.034. So the standard deviation is going to be, the variance is 0.034. Now standard deviation, we put this here. It is going to be, we are going to get 18.43. All right, so that is our portfolio standard deviation. Now, what's the next question? The next question is asking, hey, already almost 40 minutes. The next question is asking that comment on the portfolio standard deviation in comparison with the standard deviation computed. So basically, you are just going to compare the portfolio standard deviation, which is 0.1843, and then the individual standard deviations. We have 0.476, 4763, and then we have 0.445. So you can see that it is actually less riskier when you invest in the portfolio, right? Rather than investing in the asset individually. When you invest in the asset individually, the risk associated to them is higher as compared to, so you see, when you do them individually, this is the risk for Y, and then this is the risk for X, right? So when you compare them to the risk, when you put them together, right, you can see that when you put them together, the risk actually reduces. You get it? So the risk actually reduces with that one. So the you recommend that, or you say that when uh, when you invest in the portfolio, when you invest in portfolio X and Y, the risk is less as compared to investing in the assets individually, right? Then you put the standard deviation there, right? So the 10th one is saying that assuming you are told that asset Y represent the market return, compute the beta of the asset. Compute the beta of asset X. What does this tell you? So now beta is equal to the covariance of X and Y all over the market return, right? Normally, we associate it with variance. So the covariance of X and Y give us negative 0.165, right? Now, they are saying that, in the question, they are saying that assuming you are told that asset Y represent the market return, so you are coming to use asset Y to represent the market return. And now we are going to take the variance of asset Y to represent this. So the variance of asset Y has to be computed up here. So you see, if they miss one step, when you're now wrong, the variance of asset Y is, this is the variance, 0.2269. So let's go. So when we do that, 0.7272, something like that. So and it's negative. Negative 0.772. So this implies that now, you see, just the beta being negative, okay, no? It implies that asset X moves in opposite direction. The return of asset X moves in the opposite direction of the return of the market, right? So if the return of the market is going up, asset X is what's coming down, and the vice versa, right? So that's what it implies. So let's move on. We are done with the first one. Let's move on to the section B. Section B, question 2. Right. So question 2A. It said we should discuss the general investment objectives or philosophies and the types of investment preferred by investors in each phase of life, right? So they've given us the young investors, the middle-aged investors, and then the retired investors, right? So here we are to bring out their philosophies and then the investment they prefer. So for the young investors, right? They normally aim to accumulate wealth and also capitalize long-term growth. Since they have long-term horizon, they can afford to take more risk and also ride out market volatility. So their primary focus is actually capital growth, right? And then because they also have long term, they are what able to take high risk. So they are what high risk tolerance, and also they prefer to invest in like equities, indexes, ETFs, and then cryptocurrencies. I know we are one of them. Now we move on to the middle aged investors. So the middle aged investors, what they do is that they actually shift their focus towards preserving the wealth they have accumulated whilst continuing to grow at a moderate pace. Here, they don't actually take a very high risk, right? Because they want to grow their destiny at a moderate rate. They seek to balance between growth and risk management as retirement start to come into their focus, right? And also, they prefer to take moderate risk. They like to invest in portfolios of mixed assets of bonds and stocks, right? And also, they will also want to invest in bonds separately and also real estate and dividend paying stocks, right? So that's basically their thing. Let's move to the retired people. So the retired investors. So the retired investors, the main goal for retired investors is to generate income from their investment to support the expenses. Some of the expenses include they paying their children's school fees and the likes, right? While preserving their capital. At this stage, minimizing risk and ensuring longevity of their retirement. So what they are going to do is they are going to save small, and the risk that they take here is actually small. They take lower risk because here they are trying to preserve what they have, right? And then generate small income. So they will want to invest in fixed income assets or annuities or dividend paying bonds, right? So that is it for this squad. What's the next question? Suppose there are only two stocks in the market and the following information is given. The beginning index is valued, the beginning index value is 100, right? Now, I is saying that we should construct a price weighted index and calculate the percentage change. So let's construct a price weighted index. I wish I could do this in Excel. Okay, let me just do it. All the stuff here. Okay. Right, we just want to know the price at the beginning and the price at the end. So closing or price ending and the beginning price. And just put it there. So we have Starlight, cool. And we also have Round Best Inc. The opening price is 6 for this. This one is 12. Now the closing price is 6.6. And then the closing price for this is 10. Right. Now, what we need to do is we sum them. There's actually 18 plus 16.6. Then we find the index. The index has already been given to us that the initial index is 100, right? The divisor is supposed to be also here. Now we need to find a divisor. If we want to find a divisor, divisor is going to be the sum over the index, which is going to be 18 over 100. Then you're going to get 0.18. So that's the divisor here. Right. Now, there is a price change here, right? Price has changed from 6 to 6.6. So now we need to calculate the new index, right? So the new index, since there's no stock split, so we maintain the divisor. So the divisor will still be 0.18. And then the index is now going to be index is also equal to the sum over the divisor. So with this one, the sum is 16 points. The divisor is 0.18. So when we divide, we are going to get 92.2. All right, so that's it. Now we are told to find the percentage change. Right. The first one, we assume say it is 100%. Now, if we want to find the percentage change, we can either use the sum or we can use the percentage. So we can use the index. So let's use the index. So percentage change is going to be the new index, which is 92.22 over the old index, which is 100 minus 1. What's 1 percentage times 100? And we are going to get 7.8%. So percentage change here, wait, here will be dashed instead. Here will be 7.8%. All right. So that is it for the first one. Let's go for the value weighted index. So for the value weighted index, I think when I use the Excel, it will be better because the one. So the value weighted index, I'll have the stock opening price. Let me write opening price. Full price is opening price. Then we have the closing price. Let me do it C price. Then we have the number of shares. Then we have opening market cap. Then we have closing market cap. So the stocks are here. We have Starlight. Then we have Round. This opening price is 6. Then 12. And the closing price here is what? 6.6. And then this is 10. The number of shares for this one is 100. And then the this one is for they are in million. So market cap is going to opening market cap is going to be equal to the number of shares at the opening, the number of shares times the opening price. So this times the number of shares, then this one is going to be equal to this times this. All right. Let's compute for the sum. We're going to sum here. That's the sum here. Now let's take this one also. Now, this is also um, equal to this times the closing price. Hey, sorry, divided this. Then this is equal to this also times the opening price, the closing price, sorry. That's it. So we sum that one to right. So if we want to get the index, if we want to get the closing index, so the opening index is actually 100. So closing index, the closing index is going to be the closing price or the closing market cap, which we have here to be 5160 over the opening one, which we have to be 6,000 times the opening index, which is 100, right? So this is going to give us 86%. So the closing index is now at 86%. Percentage change is going to be equal to the closing price 5160 over the opening price 6 million minus 1 times 100. And we are going to get minus 14%. That's our percentage change. Now, the third part of the question is saying that what is the purpose of a divisor? So the purpose of a divisor is to adjust for changes in the stock prices that do not reflect the actual performance of the index. So some of the changes that happens in stock prices can include stock splits, the paying of dividends, right, and other stuffs. So a divisor will try and then make sure that the index is still intact, even though there is a stock split, right? So now, I've been saying that suppose Round invest in corporation split for 3-for-1. What will be the value of the new divisor? So when we check up here, right? The divisor is what? 0.18. And here it is what? Still 0.98, right? So when there is any stock split, we have to try our possible best and then maintain the divisor. But this question was actually silent on whether the stock split was at the beginning or was at the end, right? Whether the stock split was at the beginning or was at the end. So what I will say is that I'm going to do the divisor for both at the beginning and at the end. Any of them will be marked, right? So now closing. Let's do for beginning divisor. So The beginning, the index was what? 100. Now, the sum was, what was it? 18, right? And now the divisor is what? The divisor was what? 0.18, right? Now, there's a stock split of 3:1, and it's affecting what? Round best. So if there's a stock split of 3:1, then we are supposed to divide the round best stock price by 3, right? So now things are going to change to this way. It is going to change from this 18 to something different. So now the stock of Ranvest at the beginning was 12. So 3:1 means you are going to divide it by 3. And now we are going to get 4. So price of Ranvest stock is now going to be at $4. So if you want to get the this thing now, we are going to still maintain the 100 is equal to now Starlight's stock is still at 6. So 6 plus 4 all over. Now the divisor, we have to change it, so we don't know, right? So this divisor is going to be 10 over 100. This is now going to be 0.1. So opening divisor will now change to 0.1. And then now let's look out for closing divisor. So closing divisor will now be at the closing time, run best index stock has changed to what? 10. So when divided by 3, then so 10 divided by 3 is going to be 3.33 and the rest. Right, so now it means that the divisor, the index, for example, which is 92, is going to be equal to the divisor, we don't know, right? And then it is going to be 6.66, sorry, 6.6 plus 3.3. Right. So at the end, x is going to be equal to 9.9 over 9.2. We are going to get x to be 0.107. So this is going to be the closing. So this is going to be the divisor. If this is going to be the divisor, if the stock split should happen at the beginning, and this is going to be the divisor if the stock split should have happened what at the end, right? So let me go to the next one. So we are done with question 2. Now let's move to question 3. Question 3 is asking us of, first we should explain, or we should define mutual fund and explain its basic structure. So a mutual fund is a type of investment vehicle that pulls money from multiple investors to collectively invest in a diversified portfolio of securities such as stocks, bonds, or other assets. The fund is managed by a professional portfolio manager who allocates the funds in line with the investment objectives stated in the fund's prospectus. So some of the structure or the basic structure that it is going to have is, it is going to have the fund manager, and it is going to have the investors that are investing in it. Then it is going to have uh, it is going to have a security portfolio, right? So I think this is going to be the basic one, and also it is going to have a net asset value, right? So it is also going to have a net asset value. I think so. So I think that's okay for this particular one. Then the B is saying that discuss the key advantages and disadvantages of investing in mutual funds. So some of the advantages are there will be a professional manager who is going to manage your accounts. So if you invest in mutual funds, you don't need to trade them yourself, right? There is a professional one who have more expertise in the field to be managing your account for you. And that's an advantage since it will reduce your losses on the market as compared to if you yourself that you don't know anything, you go and then do the thing yourself. You are going to Shisika, get it? Uh, so that's the first one. The second one too is diversification. Actually, mutual funds brings in a form of diversification because it's going to what buy different kind of securities and then put them in one basket, right? So maybe you might be having a small amount of money that might not be able to what deal in diversification, but because you've invested in the mutual funds and it is a pool of resources, they are going to diversify your money for you and therefore reducing the risk, right? And the other one too can be liquidity. So mutual funds can typically be bought or sold at the end of the trading day. So at the end of trading day, you can actually sell the destiny your mutual fund if you think you've what made a return or you want your money back. Now let's move to the disadvantages. So some of the disadvantages include fees and expenses, right? Mutual investing in mutual funds will actually let you pay some fees and then management expenses, right? And another advantage is that you will lack control of your funds because you're not the one going to trade your funds, so you lose what control of your funds. The third one is tax implication. Whenever you sell an asset in a mutual funds, you are going to pay a tax on the capital gain, right? And also, another advantage is that a disadvantage is that you are only limited to getting your selling or buying the assets at the end of the trading day, right? So there is some kind of a disadvantage here since you are not going to buy the assets any time of the day, but just at the end of the trading day. All right, so let's move on to D. D is saying that consider a mutual fund with an initial net asset value of 10 over 1 year period. The asset has increased to 12.5. Calculate the percentage return on the investment for an investor who purchased the shares at the initial net asset value. Discuss the significance of this return in evaluating the funds of the in evaluating the fund's performance. So now we are coming to compute the percentage return, or what did they say? Percentage return, right? So percentage return is going to be the new price is 12.5, the new net asset value is 12.5 over the old one minus 1 times 100. Or you can also do it 12.5 minus 10 over 10 times 100. It's still the same way. So the return is actually 25%. Right. So this actually tells us that investing 1 year in the mutual fund has increased its capital by 25%, or its capital has what? Appreciated by 25%. Now, he is saying that analyze how changing economic conditions such as inflation, interest rates, and economic growth can influence asset allocation decisions. So, uh, changing economic conditions such as inflation, interest rates, and economic growth can actually influence asset allocation decisions. So during inflation, investors may shift from bond to equity, real assets, or commodities to hedge against the inflation, because they think that when they go and then invest in that particular those assets, they are going to reduce the risk of what they losing their purchasing power. So rising interest rate typically hurts bonds and stocks, promoting a move towards short-term bonds or cash equivalents. In strong economic period, equities become more attractive, whilst bond may underperform. In slowdown, hence, investors often seek safer assets like bonds or dividend-paying stocks. So that's basically the answer for E. Now, the answer for F is provide a brief description of investment companies, including their roles in financial markets. So, investment companies pool funds from investors to invest in diversified portfolios, offering professional management and easier access to the market. The main types of the main types are mutual funds, open-end, closed-end funds, and then ETFs. So we've already spoken about mutual funds, where it is a pool of different kind of assets in one basket. The open-end kind of investment company is a firm that can continuously issue shares, right? It will issue share today, and then it can issue again tomorrow. But the closed end issue one, and then that's for all, right? And then ETFs too, as we know, it is more or less like the pool of destiny. So they play a key role in financial market by improving capital allocation, market liquidity, and then risk management for investors. And then H, supposed to be G, right? It is asking the difference between open-end and closed-end investment. So the difference between open and closed-end investment is what I just said earlier. For open-end, they are able to issue shares even though they've issued another shares. Like even if they've issued a share today, they will be able to still issue another one again. But for closed-end, once they issue the first one, they will not be able to issue another one to the general public, right? So that is the difference. Now, let's move to question 4. Question 4 is saying that a financial security market is any arrangement, whether manual, electronic, or face-to-face, that bring buyers and sellers of financial securities together. A good and reliable financial security market is relevant for smooth operation of financial security. Given your knowledge in investment fundamentals, mention the three, mention and explain the three factors that make a good and a reliable financial security market and facilitate operation of the market. So uh, the three factors include liquidity. So investors can, if a financial security market is liquid, it means that investors can buy and sell securities easily without affecting the market price. And that's one of the factors. The second one is transparency. So transparency deals with security trading prices and company fundamentals should be timely and then accurately disclosed. The third one here is that there should be what regulations and then legal framework. So a well-regulated market ensures that rules are in place to protect investors and maintain market liquidity and prevent unethical behavior like insider trading and market manipulations. Now, B is asking us to state the difference between auction market and dealer market. So for auction markets, what they normally do is what there's more of like a bid, right? Someone will there's more of bid and ask prices in there. So someone will be bidding and the like, and more like more like the auction market will actually connect the buyer and the seller, right? But for the dealer is actually having the security in stock and then is selling it, right? So the dealer actually deals with the investor directly, whilst in the auction market, there is a connection between the auction market connects the seller and then the buyer of the security, right? So that's the difference there. And then bid and ask price. So the bid price is actually the maximum or the highest price a buyer is willing to pay for a security, whilst the ask price is the minimum price a seller is willing to accept for a security. Now, third market and fourth market. The third market refers to the trading over the counter, right? So trading over the counter, while the fourth market refers to direct trading between institutional investors and they are without the help of brokers. So with this one, institutional investors are trading among themselves without brokers. And then the fourth one here is short sales and then margin. So for short sales, it involves the sale of a borrowed security with an expected bearish market sentiment. Whilst for buying on margin, it involves borrowing money from a broker to purchase security with the expectation that price will increase or with the expectation of a bullish market sentiment. Now, limit buy and limit stay and buy, limit buy order and then buy stop order. I've explained this so well in the video, in those videos. So the limit buy, for example, is an order that is placed below the current price of the market. That when market gets there, they should what? Issue a buy transaction. So it's an order, it's a buy order that is below the current market price. Whilst the buy stop order is a buy that is above the current market price. So it's a buy order that is above the current market price. And that is the stop buy order. Now let's move to the C. The C is saying that assets and liabilities of an investor are valued at 150,000, 100, and then 100,000 respectively. If the investor operates at a margin account and is expected to have a margin of 30%, what will be the price of the asset? So with this one today, Martina Juan until later has some answer from a friend, from two friends, and I confirmed. So here is it. P is equal to assets minus liability all over the margin. So maintenance margin. So P will be equal to the asset is 150,000, liability is 100,000, The margin is of 0.3. Then we are going to get um 16.6. So this is it for C. Now let's go to the A. We are done. So it's left with this one. Okay. So question 5. Question 5. Imperium Capital Investment recently appointed you as a financial analyst on your first day at work. Father Robert, who is a lawyer with significant experience in investments in stocks, was assigned to you by your boss to explain to him some concerns he had raised regarding the composition of stocks in his portfolio managed by Imperium Capital Investments and wanted further clarification. Investment management is easier when returns are normally distributed. Specifically, standard deviation is a good measure of risk when returns are symmetric. As if security returns are symmetric, portfolio returns will be as well. Many investors like Father Roberts today believe that deviations from normality of assets returns are too significant to ignore. What if excess returns are not normally distributed? In this case, standard deviation no longer becomes a complete measure of risk. With this knowledge, Father Robert has printed a distribution of the selected stocks to you. So that's it here. Father Robert, this figures number one analyze and also that be or the distributions neighbor. So first, they're asking us to list the 4 moments that can be used to measure, that can be used to describe the shape of the investment returns distribution. So the first 4 moments that can be used to describe the distribution is I, mean. I is variance. I is skewness. IV is ketosis. So these are the 4 distinct. Now, I is saying that Father Robert is worried about the shape of the distribution from above. From some of the stocks in his portfolio, including the Kuban Fan Milk, Goyle, and then BOPP. As a top notch, meaning do top notch, even down notch, I mean do it. I'm on pass as a top notch UGBS trained financial analyst. Explain to Father Robert in context of the risk and return levels of the selected stock based on the shape of the distribution. So EcoBank is actually positively skewed, right? So we have some skewness. So in tutorial session 5, I made this explanation that we have a normal distribution, right? We can have a skew to the right, or this is negatively skewed, and then oh, so something like this. So you can see the mean is here, right? So anything that goes to the left-hand side of the mean is negatively skewed. Sorry, it's positively skewed because the actual one, the normal one is here, right? And we are trying to compare the one that has deviated to the normal one. So it becomes positively skewed if it is at the left-hand side and becomes negatively skewed if it's at the right-hand side. So this is positive and this is negative. And this is normal, right? So when it is positively skewed, what it means is that the stock has higher chances. I'm coming. So positive. All right. So now, when it is positively skewed, for example, what it means is that the stock has higher chances of small but frequent losses with potential for rare significant gains. And here, risk is low. The reason why risk is low is because the normal one can be, let's say, 10 here, and this one will be around 5. But if it is here to be around, let's say, 15, you can see that the negatively skew has a very high risk, and then the positively skew have a what? A low risk, right? So that's what I just said, that it will have a higher chance of small but frequent, sorry, but frequent losses with potential for rare significant gains, and then risk is low, right? So that is it for the EcoBank. So, oh, the EcoBank and I'm already explaining it, so I can leave the same thing here. Now, this is farm milk, and I've just explained everything here already. So farm milk is what? Negatively skewed. So when you check this and then this as a measure of the risk, you can see that since it is negatively skewed, it's what have what a very high risk because it's what actually underestimating it, overestimating the normal distance. So now the distribution of fan milk is negatively skewed, which indicates that the stock offers frequent small gains but carries the risk of rare significant losses, right? So it have a higher risk, right? So the stocks of EcoBank carries what higher risk. Now let's go and then talk about ketosis. This is a skewness. So basically, this is skewness. So this is how the skewness look like. Now let's go and talk about the ketosis. So for the ketosis, we have normal ketosis, we have positive ketosis, and we have negative ketosis. So I'm going to do that one here. So this is positive ketosis. I'm friend in Hufrobi. I said, no mean to me, but the other name is positive ketosis. Yeah, in fact, positive ketosis. We have the normal one, rate is not in this particular question, so I won't do the normal one. We have the negative one. So now, this is what we are having here. See, we are having these two here. We are having the positive ketosis and then the negative ketosis also here. So now, what will happen to the positive ketosis one? You see, say now anything here, what is the risk? Is the standard deviation is the risk. And you can see that the positive ketosis is not able to actually handle all the risk. You can see that a lot of the risk will be outside because it's what it has a thick tail. It has erected, not direction you're thinking about. It has erected. So you can see that it will have what? some risk outside that it will not be able to what cater for. So this will make um, um the stocks of gold be what actually risky. So the distribution of gold exhibits a positive ketosis, which indicates that the stock is prone to extreme returns, both negative and positive, due to the fat tail in the distribution. This means that gold is more volatile and then has higher risk, right? So you can see there's more riskiness in gold's this thing, right? Gold. Explaining about gold. Now let's look at the BOPP. The BOPP ni deɛ ntoma no akata obiara so akata beebiara akata enye beebiara mu but most majority nti akata yi you can see say it will cover most of the risk. Do you get it? It will cover most of the risk. Akata obiara akata bebree so nti no kakra bi na ɔmo nan bɛpie a wɔbɛde ɔmo nan. You get it? So this makes BOPP stock less riskier because it has been able to estimate almost all the risk. Do you get it? So the brofo that I've written down here is that the distribution of BOPP have a negative ketosis, meaning the stock are less likely to show extreme deviations with clustering return close to average, and then has a lower risk or less risk. So this is actually not something difficult. You just write some small brofo and put your brofo and then you are going with example. As far as you've written something, they are not going to. So most of my advice I give to people for exams is that if you don't know something, if a question be there and you don't know, don't leave it blank. Write something. In university, there's nothing like wrong. When you write something and it makes sense to more, at least 4, you can get 2 or 1.5. It can push you somewhere. I don't leave a question paper blank. Oh, if I don't know, I will paraphrase the question and then put it there. So the third option is saying that after your discussion with Father Robert, another client called Falakas came to your office with similar concerns. However, Falakas only knew about the standard deviation as the conventional metric to measure risk. Hence, he wanted to know the 4 additional types of risk he can use to gauge the risk of financial assets in his portfolio. What will be my response? What will be your response? So the additional type of risk metrics are, we have the value at risk, value at risk, we have expected shortfall or conditional value at risk or expected shortfall. Then we have lower partial standard deviation, LPST, lower partial standard deviation, standard deviation. Then we have Sortino ratio. All right. So if you find this video helpful, don't forget to like this video for me. Oh, like this video for me. It's nothing, but it just makes me happy if I know that people actually enjoy the video. Right. So think we are done with I, or we are done with A of the question, which is simple. I think this one was actually causing the chaos. This one, everybody can do it. So B, I, what rate stock? So consider the return, rate of return for stock A, B, C, and the XYZ, which we have here and we have here, right? Rate stock has greater dispersion around the mean. So greater dispersion around the mean is basically asking you which stock has the highest standard deviation. So BI. First, if you want to calculate for standard deviation, you do what you compute for the mean, right? And the mean is just the returns. So 20 plus 12 for ABC. 20 plus 12 plus 14 plus 3 plus 1 all over 5. And we are going to get 10 for this one. And also, with this one, let me use calculator to do it fast. Node 3, 2, let me put the returns there, 20, 12, 14, 3, 1, 30, 12, 18, 0, -10. So the mean for X, we find it already. Then we find the mean for Y, 5, that's also 10. Right, so the mean for X is 10. Okay, so let's move on to finding the standard deviation. So standard deviation for X is going to be taking the individual returns subtracted from the mean. So 20 minus 10 squared plus 12 minus 10 squared, all going up to 5 minus 1. So I can just do this quickly on the calculator. So that's what I'm trying to do. On the calculator, standard deviation of X is going to be 4, which is the sample standard deviation. So 7.91. So 7.91%. If you want to find the variance is going to be the standard deviation squared, 62.5. Then finally, we also go to Y. Oh, so we first start with the mean, sorry. Mean. Y. For Y's phone, we are going to just add all the distance like that. 30 plus 12 plus 18 plus 0 plus minus 10. over 5, and we are going to get the same thing here. Now we find the standard deviation, which is going to be take 30 minus 10 squared plus the bracket 12 minus 10 squared, then it will go like that. So you will do it for all of them, then divided by n minus 1. It is equivalent to 5 minus 1. Right. So standard deviation, variance, standard deviation. Let's come back to my calculator. Shift 1, 4, 7, I guess I'm using it's 15.55. So 15.56. So if I want to get the variance, it's going to be the answer squared 242. All right. So now the question was asking us which one has the highest standard deviation. So you can see this one is 15.56, and then this one is 7.9. So you conclude that assets. What was the name? Okay, so that was this was XYZ. Right. Oh, let me write it also XYZ. And the first one was ABC. All right, so we've calculated out. So you conclude that assets XYZ has the highest dispersion around the mean. So now I is saying that calculate the geometric average returns of each stock, and what do you conclude? So let's compute the geometric return for II, geo for ABC. So what we are just going to do is, since they've given us the returns in percentages already, let's continue with that. So geometric is going to be, yes, we've solved it already in the tutorial, so I just have to go straight for it. So here it is just in percentages. So on a normal note, it is going to be 100. On a normal note, Anka, it is going to be 1 plus the HPR. 1 plus the HPR. But here the HPR has been given to us in percentage. Right? The annualized returns has given to us in percentage. So the annualized holding returns have been given to us in percentage. So what you are going to do is going to be 100 plus the annualized return, right? So let me just do it straightforward. The first one, . Oh, I don't know. I didn't get. The first one is 20%. 100 plus it is going to give us 120. This one is going to give us 112. This one is going to give us 114. This one is going to give us 103, 101. So 120 plus 112 plus 3. It's not supposed to be plus, so it's times 120 times 112 times 114 times 103 times 101. Always the power 1 over 5 because we have 5 returns minus 1. And we are going to get 108.77. That's for ABC. Now let's go to XYZ. XYZ is going to be equal to, and also, so we are going to start 130 times 112 times 118 times, this one is going to be 100 because 0 is there, so 100 plus 0 is still 0. Then this one is going to be 90. So 130 times 112 times 118 times 100 times 90 over 1, okay, raised to the power 1 minus 1. And with this, we are still going to get around 108.1. So we can see that the real return of ABC is relatively higher, right? It's just a bit higher than XYZ. That's what we are going to see, or we are going to write. We conclude that the geo return of ABC is higher than the geo return of assets or stock XYZ. Now using the ratio, using the risk to return ratio, which of the standard deviation would you recommend? So risk to return. Oh, so risk to return is basically standard deviation to arithmetic mean under to computed. So basically standard deviation over arithmetic mean. Right? So now we take standard deviation of ABC over the mean and then standard deviation of the other ones over the mean. So standard deviation of ABC. Let's start with ABC. So the standard deviation of ABC, we computed it to be 7.91. Okay, 7.91. 7.91 over the mean is 10. And we are going to get 0.791. So this is the risk to return. Now, let's do for X, Y, Z. So XYZ, its standard deviation was 15. 15 over 15.56 over 10. And we are going to get 1.556. And here we can see that the risk to return of XYZ is higher than the risk to return of ABC. So whatever you are risking there, no, that's the return. No? But when we compare it to the risk to return form, you can see that XYZ's risk to return is actually higher than the risk to return on ABC. So so with this one, I would recommend, uh, even though depending on the investors, how the investor love risk, right? So if the investor really loves risk, then he should invest in XYZ, right? Because that one actually have the highest risk, right? And then it also have some kind of moderate return. And then ABC also have the highest kind of return in terms of geometric. But when we are talking about risk to return rise, XYZ is performing better. So our advice, I will recommend the stock of XYZ to me myself. So now it says we should calculate the lower partial standard deviation. So lower partial standard deviation is basically we're looking at the returns that will turn out to be zero, right? So let's create this box in here. So ABC is starting with ABC line now. First 11, then it was 20%, the return, then it was 12, and then 14, and then 3, and then 1, right? Now, what lower partial standard deviation deals with? It doesn't want any return that will be positive. So returns that will be negative. Let me put the line up for XYZ also. Half 30, half 12, half 18. Now, so So we are going to subtract their mean from them. And then the one that will give us negative answers, that's the one that we are going to use for calculating the lower partial standard deviation. So first, we have ABC here. The first, we have 20%. 20% minus 10% is still going to give us 10%, which is positive. So we don't like it. Cancel it out. We don't like it. Now, we have 12 here. The second one is 12. 12 also minus 20 is giving us positive 2. And it is still positive. We don't want it. We have 14 here. 14 minus 10 is also giving us still positive 4. We don't want it. Now 3 minus 10 is going to give us, the 10 is the mean, the mean that we calculated upwards. So it is going to give us negative 7. And because it is negative, we want it. Now 1 minus 10 is also going to give us negative 9. And because it is negative, we want it. Now, we are going to only square. So here is the negative deviation, a negative deviation. And then here will be the squared squared negative deviation, right? Since we don't like here, dash, dash, dash. The only negative ones are the ones that we are going to square. 7, 49. 9, 81. Today. Now let's come to the lineup of XYZ also. Now XYZ also have a lineup here. 8 negative deviation. We are going to put it here. Now the mean for that particular one too was also 10. So we are subtracting to see whether we get to 30 minus 10 is giving us 20, which is still positive. We don't like it. 10 minus 12 is still giving us 2, which is still positive. We don't like it. 18 minus 10 is also giving us positive, which we don't like it. 0 minus 10 is giving us negative 10. We like it. We like that one. Negative 10 minus negative 10 is giving us negative 20. We love that one. So we are going to square the 2 first. So this one we won't square, we won't square, we won't square. We're only going to square the negative one. So negative 10 times negative 10 to be positive 100. Negative 20 times negative 20 is going to give us 400. Now, let's sum them. So sum of this plus this, so it will give us 90, 130. And then this one is going to give us 500. So this is the lower partial standard deviation formula. LSD, LPSD, PSD is equal to the root of, so here we are doing for ABC. Is going to be the 130 all over. They were 5 years, so 5 minus 1, 4. And it runs in all the blood. The 5 minus 1, it runs like that. And we are going to get 5.7. Now, for ABCL, LPSD, for ABC, A, for XYZ, right there, it's going to be the same root again. Then here we had 500 up there, all over 5 minus 1, 4. And we are going to get 11.18%. So that's the lower partial standard deviation. Now, they are saying that assuming the rate on government T-bills is 7%, estimate the Sortino ratio. So Sortino ratio actually is the LPSD big brother. They work hand in hand. So Sortino ratio so far, it's only Sortino ratio that we've read it. It's not covered in the tutorial set. So Sortino ratio is going to be equal to the return, right? The expected return, the mean that we computed minus the risk-free rates that the government is giving out all over the LPSD that we computed. So let's do first for ABC. ABC's return was 10, right? Arithmetic return was 10 minus the government is giving us 7% all over the LPSD we computed for this one. ABC was 5.7. And then this is going to give us 0.53. Now, for XYZ, also the return was 10, the risk-free is still 7, and then its standard deviation, its LPSD was 11.18. And we are going to get 0.27. That's the Sortino ratio. Now, the fifth one, the last one here is saying that Commonwealth Bank of Australia has reported 99% value at risk of 2.85. So this is the same thing in tutorial 75. So what it means is that 99% of the trading days, they are like they are less likely to make a loss higher than the 2.85. But above the 99%, then they can make losses that is higher than that. So 99% of this 126 is 1255, right? And then it means that they are going to make, they are less likely going to make a loss more than 2.85 in 1255 days. But above 2 point, above 1255, they can make a loss higher than this. That's what it means. You can write this graph down. So it's super tight. Thank you very much for watching this video, and I hope you find it insightful. You can also like and then subscribe to the channel if you're new. Thank you very much for your time. See you some other time. Hey, I think we are done for this semester. I wish you all good luck in your exams, and then Charlie, we go make up, okay? Bye.